I've always been a little bit more cautious or less optimistic than some of my friends. Mm, I think in markets generally and in life generally, we always expect things that we know are going to happen sooner than they actually do. So if you look at the Fed, there's a couple of things. First of all, this was the most aggressive in terms of percentage, the most aggressive rate hiking cycle ever. It's more aggressive than Volcker. People forget that when Volcker came in, the Fed funds rate was already in double digits. So he doubled it, which is, incredible. I'm not taking anything away from Volcker, but we've gone from zero lower bound to 5.5 in less than 2 years. That is astonishing. Or 1 year. That's astonishing. So that's the first thing. Yeah, I was a little bit surprised, to be honest, at the dovish tone in December. I mean, the Fed statement was dovish. The dot plot was, where the Fed members make their estimates of what they think things are going to be in the next year or two. That was very dovish. Big change from September. Big change on the dovish side. But then when Powell came out, he didn't push back at all, not even in a cursory manner. And he had plenty of opportunity to. He didn't push back at all from the dovish commentary, which says to me that it's quite clear that the Fed internally, they've already changed their mind. That's the important thing. Now, they're meeting this month. I don't expect a rate cut this month. If anything, we might get commentary suggesting we're not going to cut too quickly and too soon, and we're worried about inflation and so on. Unfortunately, the reports, inflation, CPI inflation, and the jobs numbers have gone the wrong way for the Fed to be. They both of those higher job numbers and higher inflation would tend to make the Fed want to be a little more restrictive. I don't think we're going to get a rate hike. But come March, which is the second meeting, I think there's a very, very good chance, better than 50-50, that the Fed will do their first rate cut. And once they do the first rate cut, I suspect, that's a mind shift. You don't raise rates, cut them a little bit, then raise them again. And so I think we're going to get a series of rate cuts in the next, let's say, 18 months. Once they start cutting rates, that's going to be extremely bullish for gold. And I don't know if I said it in the interview with you. I remember talking about, the lags and so on. But with regard to gold, I've said, for the last year, when people have been saying, why isn't gold moving more? Why isn't gold moving more? Gold will really take off when the Fed starts to cut rates before inflation is squashed. And, inflation is a long way from being over. And let's not forget, yes, but the numbers have come down a lot. But let's not forget, even if you look at the Fed's own preferred measure of inflation, which is core CPE, which assumes we don't eat and we don't eat our homes. But even looking at their preferred measure, core CPE, and looking at their own target of 2%, we're still 60% above their target. So we haven't killed inflation yet by any means. That was a long answer. I'm sorry.
Well, yeah, there's a lot to unpack there. If you would bear with me, a lot to unpack there. Really, what I would say to you, or I'd ask of you then, is like, it looks like that in all of that, a dovish Fed, it looks like gold's been building a pretty strong base over $2,000. We had a pretty good bounce in the stocks, which I thought was interesting, because that's typically what happens is the stocks lead, and it hasn't happened for a while, if you would.
Yeah.
So I thought that was interesting. And I would just, where my comment would be, or my question would be, where are we at now then, assuming that the Fed, they're certainly dovish, but assuming they do what you say and quite possibly will be cutting in the springtime or the summer, where are we that in that investment cycle, if you would?
Yeah, no, that's an excellent question. You're absolutely right. If you look back, let's just say a year, let's look from the beginning of last year. Gold has done well. And a tangent. I think gold investors always expect gold to do more. They're never happy. But
Very true. Very true.
And I'm a gold bug, so I put myself in that camp. But we always expect gold to do more. Gold's done well last year. So gold did well, but well outperformed the gold stocks. Gold also outperformed silver, and silver outperformed the gold stocks. And then if you look at the juniors, the junior gold stocks and the junior silver stocks, they were worst of all. That's over the 12-month period. And we can talk about why that is in a second. And if you just look, as you said, from October, November, I'm looking at November, the bottom, gold stocks started to outperform gold. Silver started to outperform gold. Silver stocks started to outperform silver. So all of those things are things that you expect in a bull market. But I think the market was ahead of itself. I think the market was, overly optimistic on when the Fed would start cutting and by how much it would start cutting. And we're talking about beginning of November. So we're already 2 months past that. And we've seen a bit of a retracement. Well, we've seen quite a bit of a retracement, particularly in silver and stocks since then. Where we are at the moment, I would be extremely hesitant about selling anything. I mean, unless you're doing it for tax losses, selling one and buying another or something. But I'd be very reluctant about selling. But I think we may have to wait a couple of months before gold takes off. There's always a risk in the next month or 2 or 3 that we get another high CPI number. We get another high jobs number. Again, another tangent. I don't want your listeners to think that I am, that I drink the Kool-Aid. I mean, those jobs numbers were good. But let's not forget, at the same time we had a beat on the December jobs, they reduced the number of jobs from the previous 2 months. So if you look at the 3 months, it really wasn't that good. And there's a lot more we could say about the jobs market. So I don't think the jobs market is as strong as it would appear. But nonetheless, you have a low unemployment and you have high jobs numbers, you have higher inflation. We could see another 1 or 2 reports like that. We could see some Fed spokesmen come out with hawkish statements, and that might put a damper on the market. So,
Which they do all the time.
And the market is interesting. Over the last 12 months, you probably noticed this. It's really interesting. When that happens, the market is reacting less and less and less as time goes on. So they're not really listening to all that noise anymore. But what the Fed does and what Powell himself says is still important for the market. So that's a long-winded way of saying I think we may have to wait another 2 or 3 months. And March isn't a cut in March isn't baked in the cake.
Right.
But there's another consideration here, of course, which is the election. There's an election coming up. The Fed historically, whatever Jerome Powell says, the Fed historically has not liked to appear to be political. So they've raised rates a lot. It would be natural for them, especially if the economy slows at all, it would be quite natural for them to just pull back a little bit. With the election in November, they don't have too much time to wait. So March, probably, May, I would say definitely will get a rate cut.
Yeah.
So this is a time for investors to really, if you're underweight gold and gold stocks, to really start getting to your full weighting.
Got it.
Understanding you may have to wait a month or 2.